We have the management of ENIL. The company has delivered a solid fourth quarter profit growth. Additionally, an interesting development has been a licensing pact with a US firm. So let's discuss the numbers as well as this pact with Prashant Panday, MD and CEO of ENIL, along with Mr. N Subramaniam, Executive Director and Group CF of the company. Thank you, gentlemen, for joining in. Good morning. Congratulations. Solid jump on the bottom line, and I think that is quite commendable. So, Prashant, over to you first. What is it then that led to this solid jump in the PAT? What were the growth drivers?
Well, I think I should mention over here that our story this quarter has been consistent with what we have been saying for the last so many quarters, and that is that we've been very focused on improving the margins in our non-radio business, and at the same time we've also been very focused on keeping the pricing in our radio business high and consistent, and that's what is actually bearing fruit. You see it in this quarter where the profit numbers have jumped significantly. And also remember that the radio business has an inherent advantage of high operating leverage. So every time the revenue shoots up, you find a big impact on the bottom line happening. So it's both of these factors really.
What about your margins? They have also been very, very steady. Tell us firstly, what are the levers that are, helping you achieve these kind of margins, and what is it that you're planning to do in order to be able to sustain it and expand it from here on? Prashant, my question is to you.
Yeah, and so look at the non-radio business that you mentioned. Now the non-radio business is a business that we have believed in for quite some time, and in the last 2 years we have consistently focused on improving the margins in the non-radio business. Now the margins made up of two parts, as you know. It's one about obviously is enhancing revenues, and the other is about managing costs in a very effective manner. Now through better planning and by building stronger IPs, what we have realized is that our revenues have gone up quite significantly, and equally at the same time we have managed to put a tight lid on cost escalation. So as a result of that, in the last two consecutive years now, you find margins improving very significantly. This year in the fourth quarter, the margin improvement is of the order of 500 basis points, and quarter four last year had seen another margin increase of about 400 basis points. So really in the last 2 years our non-radio business has become very, very profitable, and it is definitely sustainable, and I think we still have some more room to improve the margins in our non-radio business.
Mr. Subramaniam, over to you now, and I'm just going to roll in two questions into one to save time. But what's the outlook on ad revenue growth? I mean, how did it shape up? And also, after the radio auctions, how much cash is on your books, and what's the capex plan, if any, for ENIL?
For the current quarter, we had a top line growth of about 10%, and we see going forward a 15% growth rate in our revenue. In terms of cash, we are over 150 crores of cash as on 31st of March. Much of our expansion is already behind us, and going forward we expect the free cash flow also to grow quite significantly.
Could you, Prashant, tell us a bit about how the competition in the radio space is panning out, because of course there's music broadcast which is planning to acquire Big FM. So is it a matter of concern to you, or you're unperturbed by all the action taking place in the space?
Well, two things. I think it's a very good thing that the radio industry is consolidating. And before the Jagran Radio City big deal happened, just imagine that there were like almost, I think, 35 or 37 broadcasters. But over the last year or so, we have seen the Hindustan Times Radio 1 deal happen. So I think it's a good sign. There are, I think, eventually going to be 3 or 4 strong players in the radio industry. And I think that can only mean very good for the radio industry, because at the end of the day, remember, if the market has to be developed, it needs to take some bold moves, and that can only happen when there is some serious players in the business. So we really welcome this development that has taken place. Now, in terms of how it impacts Mirchi, I really think our strategy that we have followed in Mirchi is pretty different from the strategy that various other radio broadcasters have followed. If you notice, we have diversified significantly beyond radio. And in this financial year, for instance, our core radio business, which is purely FCT selling, is now approximately 2/3 of our revenue. So 1/3 of our revenue actually is coming from very exciting and new products that we have built on top of our radio business. So we have solutions that we provide to our clients. We create a lot of IPs. Increasingly, we are making a lot of videos to fuel our YouTube growth. And we have embraced digital in a very big way. We made 50 shows of podcasts last year. We streamed more than 700 million views on YouTube last year. I mean, the whole emphasis, the whole strategy of Mirchi, guided and cleared by the board, is to become a really big entertainment company in which radio plays a very important role, but radio is not the only business that we do. So to that extent, I really do not see this consolidation that's happening as competitive with Mirchi, but I think it's very good for the radio component that Mirchi's business has.
Mr. Subramaniam, finally, I just want to talk about that brand and content licensing agreement with a US-based radio broadcaster. So tell us, I mean, how has it helped your overall global listenership, and any more tie-ups on the radar?
So it helps in our expansion in the US. So for the US, we have two models. Model one is where we run a few radio stations by leasing it from other broadcasters, and the second model is the brand licensing deal. Over a 3-year period, we expect the profitability from the US operations and also our operations in the Middle East to be quite significant. I don't see much of an impact in the current financial year, FY20, but over a 3-year period, I expect that to be quite profitable.
Thank you so much then to both of you for taking time out to chat with us and helping us understand what the future growth plan and trajectory is looking like and what transpired in Q4. Thank you once again.